L1 Capital is a well-known name in the Australian funds management industry, and they've recently released their fourth UK residential property fund, having begun investing in the strategy in September 2017. The fund's strategy is focused on investing in fully tenanted residential property in major UK cities, excluding London, that provide reliable income streams with potential for capital growth. The objective of the fund is to deliver clients a minimum net return of 10% per annum, including a dividend yield of 6% per annum. House prices in the UK cities outside London are comparatively low cost, with a median house price of approximately 4 times household income, which compares favourably to Sydney at 11 times and Melbourne at 9 times. Similarly, it's supported by high rental yields of around 7%, which have remained consistently stable. Funds 1 and 2 are fully deployed and have met or exceeded their invested objectives. I'm joined today by Key Gann, the Chief Investment Officer for L1 UK Property Investments. Key, thanks for joining me.
Thanks, Damon. Good to be here.
So how did the L1 UK Property Fund start? Key, where did it all begin?
Sure, Damon. So a while back when I was living in London, I purchased an apartment in Birmingham, and that was really based on a number of characteristics which I thought was quite compelling at the time. So one, the rental yields were very high. I was achieving around 8% gross rental yield. I was able to get a mortgage at around 2%, and that actually created a pretty interesting theme where you actually get strong positive gearing or a positive dividend yield, which is very different to what we typically see in most developed markets where there's negative gearing. House prices in Birmingham, actually in a lot of the tier 1 cities outside of London, were actually very slow to recover from the GFC. So that it was only 2 or 3 years ago that they finally got back to those same levels. So you really had 10 years of no growth. Sterling was actually very weak. And then when I just looked at fundamental affordability, people could actually buy a home at 2% mortgage or rent at a cost of or rental yield of 7%. So much cheaper to actually buy versus rent. And it was actually just the conservative bank lending that was holding back house prices. I caught up with Mark and Raf from L1, and they actually thought this is actually a no-brainer. They'd love to put a lot of their own money in. And they actually said, actually, over time, this is actually a great opportunity for Australian investors, because when you look at Australian residential property, you sort of see a 180 or the direct opposite, negative gearing, very high price to income ratios, quite unaffordable. Wind forward 3 years, and we've developed 3 funds, and we have about $250 million in assets under management.
So can you tell me a little bit about the strategy? What is it that you do?
Sure. So we invest in fully tenanted income-generating blocks of flats in the tier 1 cities such as Leeds, Manchester, Birmingham, Sheffield, outside of London. So they're income generating and tenanted at day one, so we can start returning a distribution back to investors immediately. No development, no construction risk. It's cities such as Manchester, Birmingham, which we think are outperforming the rest of the country from a population and employment growth perspective. So for example, Birmingham, a lot of the banks such as HSBC, Deutsche Bank, Santander have relocated a lot of their middle office from London to Birmingham just because of affordability. Manchester, the BBC relocated, and currently it has about 2/3 of the FTSE 100 companies actually having an office now in Manchester as well. So it's select cities that we think over the long term will outperform. And then I think finally, with every asset that we invest in, we care a lot about what can we do differently, something different the seller hasn't done. So it's often looking at undermanaged assets which might have been starved of capital, and we could reposition them either through a refurbishment, either through service accommodation, or just optimizing the cost base. So there's a bit of value added in there as well.
So why don't you invest in London?
Sure. So London, part of our investment thesis is about finding attractive value. London house prices are very expensive. So median house price is about £600,000. The rental yields in London are very low, and unfortunately you end up with negative gearing in London. And the drivers of house prices are actually very different to the rest of the UK. So house prices, because they're quite unaffordable, it's typically overseas investors from Russia, China, Middle East that drive it rather than the local economy. And separately, when there has been a bit of volatility, such as Brexit, and also in the current pandemic, London house prices and rents have actually been more volatile, whereas outside of London, we haven't seen that impact. So, for example, just as this current pandemic, we've seen London rental prices drop by around 1% over the past 12 months. Outside of London, it's actually continued to grow at about 3.5%.
So overall, how do you think the sector's performed through COVID?
Sure. So if we actually look at rents throughout this sort of COVID period, as sort of mentioned, rents have actually held up quite well outside of London because it's still very affordable and people need a place to live. When we actually looked at UK rents, UK-wide, over the past 70 years, the greatest decline that you actually had in any particular year was less than 1% throughout a recession. So typically rents grow at about 3 or 4% per annum, in line with inflation or long-term wage growth, and over time, it's actually inherently a very sticky product. We've paid a fair bit of attention to tenants and are they actually paying throughout this current COVID period. And interestingly, the residential sector has again held up very well outside of London because of affordability, people needing a place to live. So collection rates for the whole market is sitting at around 96% throughout the peak of the pandemic. Other sectors, particularly commercial, that's fallen to below 80%, so a bit more volatility there. I guess looking at house prices over this period, these past 6 months, there's obviously been a number of transformational events. At the start of the year, it was the UK election, a lot of pent-up demand being released, and house prices were growing about 1 or 2% every month. As we moved into March this year, probably the height of the pandemic, the UK went into lockdown. From March towards May, that's where we had prices actually staying very stable and flat. And as the UK eased out of lockdown in June and July, house prices returned back to growth on the back of, again, the pent-up demand being released over that time period. And more recently, a few weeks ago, the UK government announced the removal of all stamp duty for house prices below £500,000, which we actually think that will act as a bit of a tailwind in the coming months for the housing sector going forward.
So, Key, why do you think overall that an investment in UK property, residential property, is attractive to Australian investors?
Sure. So when we actually look at the sort of return components, the fund generates a dividend yield or has an investment objective of between 6 to 7%, which we think is actually very attractive in the current low interest rate environment. Our private funds are exceeding those investment objectives, so delivering in excess of 6% per annum. And when we look at the rental income, it's actually a very stable, non-cyclical form of return. So we don't have to believe too much to deliver a 6 to 7%. From a capital growth perspective, house prices outside of London continue to grow, not at stellar rates, but just stable 2 or 3% per annum. And with a bit of leverage that we gear against the properties, that provides a relatively solid capital gain. But what we're also looking to do is also how we reposition the assets or accelerate the growth through refurbishment to further drive the return profile over time. And then when we actually look at the asset class itself, interestingly, it's quite uncorrelated to typical equity markets or bond or debt capital markets. So we find it as a relatively compelling investment opportunity where there is a very stable income delivering a solid yield in a low interest rate environment with scope for capital growth if we get 2 or 3 things right.
Yeah, I think from an Australian investor point of view, that uncorrelation is something that's very important. Key, thanks so much for joining me today. Much appreciated. Good luck with the fund and stay safe.
Thanks, Damon. Appreciate it.